good. Thank you very much, Paul. Okay, so look, let's kick things off with today's webinar. Personal contributions seem so easy until they're not. I'd like to welcome to the webinar as my co-host today, Nick Anglam, who is our client manager over there in Melbourne. Welcome along, Nick.
Thanks, Tim. Thanks for having me. Great to be a part of it today. Got some great weather today, so it's a good omen for today.
Nice, excellent. And so, Nick's joining me because we've been talking a lot about a lot of these issues linked with personal contributions recently. We've actually had a couple of scenarios around, 1 July pension commencements where people are topping up with contributions as well. But we've also been dealing a little bit in regards to the whole, insurance and income protection as well. And so we want to touch very briefly on that through the presentation. So as always, if you've got any questions throughout the webinar, please don't hesitate to shoot them through to us, and Nick and I will work through them together. So as I said, welcome along. What I would like to obviously disclaim is that this is everything as of, well, yesterday, today, whatever the date is. Actually, I've already skipped ahead, haven't I? It's not quite the 29th. So there you go. This is everything as of tomorrow for a webinar point of view. So everything when it comes to contributions is, well, it's ever evolving. And one of the reasons why I thought this was a good webinar to run was that we ran our contribution workshop back in March and April earlier this year. And even since then, so much has changed that it's one of those areas that if you're not continually moving with it, then you can relatively quickly fall behind with regards to to how the rules operate. So whilst we're focusing largely on the personal deductible contribution stuff today, as I said, if there's any questions in regards to anything else, contribution link, by all means, shoot the questions through to us. So we'll be looking at the requirements to lodge a notice of intention, specifically how benefit payments can impact those deductions, because that to me is one of the key issues there, but also the tax impact of making excess contributions. So we've seen some changes from the 1st of July this year, and they're good changes. They're unexpected changes, but we have seen some changes that will impact the whole excess contribution regime. So it's good just to have a bit of a chat through those issues. So look, what I wanted to start with reference to personal deductibles is when I did my workshop on the contributions, I kind of identified what I would consider those contributions that are pretty much inside the box of stock standard super contributions. You're going to get them across the majority of superannuation funds, be it retail, industry funds, and self-managed super. And then those contribution strategies that are fair and squarely, or I guess more largely outside of the standard box, and will predominantly be in the domain of self-managed superannuation. Now, some of them will sit elsewhere, but largely these contribution strategies are driven by SMSF members more than anybody else. And what I wanted to really highlight here with my red and green references is how and where personal deductible contributions might impact some of those contribution opportunities or contribution strategies. And so, firstly, with the red ones there, government co-contribution, again, it's only a minor consideration or a minor issue for us, but to be entitled to the government co-contribution, you've obviously got to make some non-concessional contributions. So you don't want to effectively fully deduct the entirety of any personal contributions to avail yourself to that. Downsizer contribution, again, is exclusively a non-concessional style contribution. And the reason I've highlighted that is because it can actually have an impact when we're talking about the notice issues and notice requirements issues that we need to be mindful of. You'll see there, rather oddly, that I have highlighted the First Home Super Saver scheme both in red and in green. That was a deliberate thing. It wasn't a typo on my behalf there, and that was because it's really to highlight that if you've got clients that are looking at the First Home Super Saver scheme, then if they make their contribution and they don't lodge their notice of intention, then obviously it's going to take the benefits out from their non-concessional amounts versus from the concessional amounts if their notice is claimed, or if they lodge their notice. And of course, then you've got to accommodate the tax that's been withheld as well. So from a First Home Super Saver scheme, it's geared up towards the capacity to make personal deductible contributions, but we have to make sure we understand all of the issues associated with it. And then if we look at the green contribution strategies, your low income super tax offset is all linked to our low income earners who are making potentially personal deductible in addition to super guarantee. Contribution splitting is exclusively available for deductible contributions, concessional contributions. And then we've got our carry forward concessional, which obviously is very intimately linked to the personal deduction. The other one there being the contribution reserving, the double deduction concept. So I am going to work through that from a strategy point of view. That's probably the only one I really want to touch on to make sure that we understand what our notice requirements are with that one. And beyond that, we do have our work test exemption. And this is going to be an interesting piece come 2022 if A, the government are re-elected, and B, they follow through with their proposal to allow people to contribute post age 67. It won't apply to personal deductible contributions. So anyone after the age of 67 will be required to meet the work test or be able to contribute under the work test exemption. So having less than that 300,000 total super balance at the preceding 30th of June. So, there's a number of strategies that sort of come to me straight off the top of my list that are fairly heavily reliant on the personal deductible scope. Nick, are there any other sort of strategies that in the client manager realm that you see coming up on any sort of semi-regular basis?
I think you sort of touched on the double deduction is quite popular, but also see a lot of contribution splitting as well. That's becoming a lot more popular. But I think those two are the main ones that seem to be the most popular, not to mention, obviously, bring forward non-concessional contributions. Yeah, cool. Okay, and it's good to get that sort of feedback because, for me, I just make assumptions that everybody's going along and doing all these sorts of things. And so to actually see it then apply in the real world space is certainly beneficial. And so, just to follow through on that, if I just very quickly, I guess, identify the SIS rules which stem from all of those requirements and the impact they have on personal deductible contributions. Really, the only point that I want to highlight here is that top one, which is members aged under 67. And so for me, like the game changer that we currently have, which is access to making contributions without satisfying any work requirements prior to age 67, but also the condition of release being satisfied at age 65, it really does put us in this significantly large window of opportunity where people will be both withdrawing benefits and contributing to super simultaneously in certain circumstances, whether it be under recontribution strategies or for other reasons. And if they've got investment income that they're looking to offset from a tax point of view, because obviously any pension income that they're getting from the fund is going to be tax exempt. But if they've got any other income outside of super that they're looking to offset, then they're going to look to use the personal deductible contributions. And so it does open up this window for them to do it, but it then also creates, I guess, administrative, I won't use the word nightmare, but I just did. It creates administrative issues associated with the timing of those notices. And that's a real key part of what I want to address in today's presentation, is making sure that we understand not just the advice piece around contributions, but more importantly, the trustee requirements and the admin requirements to make sure that people do the right things. So we've got all the other contribution opportunities, but to me, that whole 65 to 67 window is really significant. And of course, where we're going to be at post
potentially post 2022 won't really impact that so much in the space of personal deductible, because they're going to be excluded from the removal of the work test from 67 to 74. So it'll only be those continuing to work that will get access to it. So, there's a bit of an overview of strategically where we sit with a lot of these key issues, the various strategies that people might contemplate. But I did want to touch on the reserving strategy, particularly because, I mean, we're now in the 21-22 year, and we're now firmly fixed with 27,500 as our concessional contribution limit. I should never say that, I should never say that we're firmly fixed with it, because we've seen it jump around and get all the way to 35 before jumping back down to 25 again. So I really shouldn't say that we are fixed there, but let's assume that we are. So what we know is that from our double deduction strategy point of view, from a SIS point, we've got to allocate our contributions within 28 days following the end of the month in which they're received. But then from a deduction point of view, we claim the deduction in the year that we receive it. Now, as a side note to this, and I don't like to, I guess, draw attention to too many issues that I see as potentially problematic, but October is a fairly critical point in time for self-managed superannuation funds, because we're actually seeing the move towards SuperStream for self-managed super funds and rollovers. Now, we already know that SuperStream applies for employer contributions, but not for related party employer contributions or small employer and personal deductible contributions. But if we ever move to a full sort of engagement with SuperStream from a let's call it a personal deductible point of view and those related party employers, then this reserving strategy then will, to me, still be possible, but it'll be a little bit more restrictive from a timing point, because one of the key issues of SuperStream was that for APRA funds, contributions need to be allocated within a much shorter time frame, so you don't have that 28 days following the end of the month in which they're received. So, if we're talking about a 3-day turnaround or something like that, then it's going to encroach fairly significantly on that end of year strategy. Albeit that I know most self-managed super funds will have the contribution go in June and then make the allocation on 1st of July. But it's just really about ensuring that people understand that, and so they're not operating in an environment where they think they've got till the 28th of July to make decisions. And I think that's one of the key issues that people need to be mindful of. And perhaps if I just pose one question to you, Nick, in the client management space, from a day-to-day basis, do you find that most people with this double deduction strategy understand the concept around the timing of the contribution, that it must be after the 1st of June and must be in before the 30th in order to be able to undertake the strategy?
It's when they obviously they approach us about the strategies, we make that pretty clear that it needs to be in before the end of June, allocated within 28 days at the end of the next month. So we put a lot of emphasis on sort of making that quite clear, so that there aren't any issues that happen in that either the contribution goes in too late in July, or the contribution gets allocated too late. So it's definitely something that we really put a big emphasis on, making sure it's done correctly, so that we don't have any of those issues down the track.
Yeah, good. And look, I guess that's important. It's one of those key things. I know, having dealt with these ever since the introduction, I guess, ultimately, of the contribution reserving concept, which really sort of stemmed back to the 2007 super reforms. There was always issues around the timing, and there still is issues even in the world that you operate now with electronic transfers and fast banking. There's always still issues around when contributions are made, and so the whole idea of making a contribution on the 30th of June is still so risky from a strategic point of view, because it could fall over or take time to allocate to the bank account, and therefore be triggered into the next year. And so I guess that means that in the current environment, we can go back a few days into June to make the contribution and allocate by the end of July. But if we ever move to a shorter allocation timeframe, then it's going to be problematic. But the way that the strategy would work is that in this circumstance, someone would make their 27.5 contribution ultimately any time in the year, but definitely up until 1 June 2022. And then they would make their second contribution between the 1st of June 2022 and the 30th of June and allocate that second one prior to the 28th of July 2022. Now, what that would provide for is it provides a deduction in the 21-22 year of $55,000. And so it's a matter of then ensuring that the notice of intention to claim has that full $55,000 on it. Now, this is where administratively it becomes, I guess, problematic, because what we have found historically is the ATO system never really coped with this. And so what it actually meant was that we still, because we used to try and do it via a reserve, a contribution reserve, hence why I still call it a contribution reserve. But we've now got to the point where the ATO require us to allocate it to the member as we would normally, and then for the member to be proactive in actually requesting the allocation via the tax office to the following year's contribution cap. So it's effectively that two-stage process to ensure that that the client doesn't get the excess notice, and then to be vigilant to monitor what communication comes from the tax office, just in case there is some miscommunication and the request hasn't been made potentially to get that amount reallocated. So, that's how that reserving and double deduction works. It is ultimately a strategy that is very good for those who potentially have a large tax event occurring in the current financial year and are less likely, potentially because maybe they're moving into retirement or some other reason they'll have less income next year, that they want to offset that tax event in year one. So that's really where that strategy works, and the notice of intention process is pretty much the same as it would be in a standard admin year. So I guess what happened back in 2017 when the government removed the maximum contribution test, or the maximum work test, the 10% requirement, and basically provided the capacity for everybody to undertake the ability to make a contribution and claim a deduction, was the first thing to come into the discussion was whether or not that would be the end of salary sacrifice. And for me, there are obvious benefits of the personal deductible strategy route, which is you've got the increased efficiency because you get to contribute directly rather than via the payroll. So you're under the control of the timing a little bit more. And I think that's one of probably the great deficiencies of our employer-employee system, and that is that contributions are allocated back up based on what we said before, based on when they're received, not for the period that they're subjected to. So when you've got employers contributing on say a quarterly basis, you'll often find that what an individual thinks is being contributed into their fund in the year doesn't actually match up with what the fund has actually received, because in July of last year you've got the contributions from the previous June, and then the contributions from this June get allocated into the next year, and it can actually be the contributions for that entire quarter. And so I know from an administrative point of view that often we get asked that question a lot when we're trying to go and do the contribution confirmations at the end of each year. When we go back and say, can you confirm that these are the contributions you received? The number of people that come back and go, well, that doesn't match my information because, I've put in these amounts and my employer, this is what I've earned, so my employer should be putting in 9.5% or this year 10% of that. It doesn't add up. And it all comes down to the timing. So certainly it does provide that increased efficiency. Definitely the increased flexibility for making ad hoc contributions from a timing point of view. And then that opportunity for employers or employees whose employers don't offer salary sacrifice. And salary sacrifice is 100% a prospective strategy. So it's got to be set in place. The employer needs to sign off on it before we actually engage, or before the individuals engage, versus the personal deductible, which generally follows suit and applies afterwards. However, and I know that some of you have listened to a number of my presentations and say, "Go, here we go, he's going to bang on about this temporary incapacity element again." But for me, it's just yesterday we had a client who actually started paying a temporary incapacity benefit, and I know Nick and I were dealing with one not all that long ago as well. And that capacity to provide a temporary incapacity benefit from a salary sacrifice, which is a non-mandated contribution, it's just always, I guess, a back of the mind strategy. Is that something you'd concur with, Nick, just from your experiences with dealing with advisors? And I know you've had dealings with a number of people that have dealt with disabilities recently.
Yeah, no, it's definitely something that I guess helps as part of that process, in that obviously there would be that timing sort of difference between when the benefit may be received from the insurance provider, but without going into that area, but it's a benefit that sort of can, I guess, fill the gap in the meantime, whereby you might be waiting for the provider to pay on a policy.
Yeah, look, and it's a valid point, and I think that's the thing, is that I know in my own circumstances with my self-managed super fund, I did move. And most of us look at income protection from a cash flow point of view, and again, we don't want to hijack this with insurance commentary too much, but it becomes a bit of a cash flow because obviously you can get the deduction on the outside. But certainly that timing issue about it's a cheaper premium the longer you wait to receive it from the insurance company. And so ultimately, if you can fill that gap, as you say, with some non-mandated employer contributions from a salary sacrifice point of view, then you can start paying some income immediately. So I think it's still a valid strategic point to contemplate from a salary sacrifice point of view. But with salary sacrifice will always come the other issues about timing and the caps and other things, and making sure that if you've got a salary sacrifice arrangement in place and your employer's also just gone from 9.5% to 10%, making sure that albeit that we do have indexation, that there's not going to be a breach of the cap. But we'll touch on the breach of the cap a little bit later. So personal deductibles, certain funds can't accept them. Common public sector defined benefit interests. So if you've got those accumulation style funds, then you can certainly receive it. Constitutionally protected funds, and some funds who elected not to accept. So that was part of the process back in 2017, that funds could elect not to receive personal deductibles. So it's a matter for employees and members to check out the rules of their fund. So importantly, I guess for us is the requirement to claim. So what do people need to do in order to be able to claim a personal tax deduction? And so what I want to do is break down some of the key issues here, and talk through where I guess we would see the main issues arising, but also what clients need to undertake with regards to claiming their deduction. So, the first thing is that if we're making personal deductible contributions, you must lodge a notice of intent to claim, and the trustee must acknowledge it. Now, I'm going to show my not my ignorance necessarily, because I've been in the admin space for many a year, but do we provide, Nick, the acknowledgement as part of the actual the same document, or is it a separate document from the notice of intention?
We generally provide it as sometimes we would get the notice of intent to claim a deduction from the advisor, but yep. We do prepare the whole sort of acknowledgement and notice of intent to claim as a package. So, yep. But we do sometimes receive the notice separately, but generally it would come as the one package.
Yeah, good. And look, and I think that's one of the key issues. It's very rare that you come across the two not necessarily being together, but as you say, if somebody has completed, say they printed the form off the ATO website or something and sent it in, or as you also alluded to, the advisor has their own pro forma, then we'll just prepare the acknowledgement, versus if they're asking us to do the complete deal, then we'll provide both the notice and the acknowledgement in the same sort of contribution kit. So it's a key though to make sure that it is acknowledged by the trustees from an entitlement point of view.
you've got to give the notice at the earlier of when you lodge your tax return, or the end of the following year, or the year following the timing of the contribution. Now, of course, that just basically means that if you're a late lodger and letting this drag on, then you don't have the capacity to go back a couple of years and claim that deduction. So ultimately, most people are trying to prepare those notices now. And again, as I touch on the strategic side of pension commencements and benefit payments shortly, obviously the sooner you do it, the better. But from a timing of this presentation, one of the key issues was, we're pretty much smack bang in the early throes of, or the late throes for those that aren't with tax agents, but personal tax returns needing to be lodged by the end of October. Those with the tax agent obviously have longer as well. But so people are contemplating this whole preparation point now. So it was a valid session to be running the end of Q1, because it's that whole tax statements are coming through from your fund managers and those sorts of things. So people are really in tax lodgement mode at the moment, and with so many people home as well, then there's probably that greater desire to prepare now, whilst they've got it fresh in their minds. So the timing is a bit of an issue. The notice can only be varied down, not up. So once you've made that lodgement, or once you've lodged that and it's been acknowledged, then you can actually vary the form, but you can only go downwards. And so why I've highlighted the next point, if you've got a new or additional notice when claiming more, where would you see that sort of thing more regularly occurring, Nick? If somebody's made their initial contribution, they've potentially lodged a deduction notice at the same point in time, will you see occasions where they will lodge a second notice in a financial year?
Yeah, I guess a recent example that we had was where the member made a contribution and then commenced a pension, and then when they got to the end of the year, put in another contribution, which then took them up to their concessional cap. And
Yep.
so that was I guess an example where there were two notices of intent to claim a deduction and acknowledgements given, both being at discrete times of the year.
Yeah. Okay. And so that's I guess a good point, and it does sort of segue into where we're heading shortly with some of the key issues around the notice requirements. But it's the situation where you're not restricted to just the one notice in the year if you are making subsequent contributions. It's just you can't go back and amend something that you've already previously prepared. Okay, that's a good thing to know. So then the notice of requirements, you do get to use the ATO form if you want, the notice of intention to claim or vary a deduction for personal super contributions, and they've got their lovely online form, which it's one of those things that it's easy to use that. It's also easy to produce your own form, and it's also easy from a member point of view just to write to the trustees of the fund, particularly if it's their own fund, and provide all of the information that form already provides for. So you're looking at making sure that you've got your name, date of birth, fund name, your member account, which for a self-managed super fund is relatively straightforward, the income year in which the contributions were made, the total amount of the personal contributions to the fund that year, and the amount that you intend to claim as the deduction. So you'll often see a differential between those two levels, and this is I guess where history becomes irrelevant because we've moved on legislatively, but this is where some people may still be operating under misguided information from what they could do previously, because under the substantially self-employed rules and the 10% requirements, previously you used to be able to claim a certain amount and then 75% of the amount above that. So you used to, for example, if you would say make a contribution of $100,000, well, you couldn't claim the full 100,000 to get a $100,000 deduction. You had to put in, let's say, $105,000 or $106,000 because of the restriction. Now, as I've always said, maths is not my strong point, so don't quote me on whether that was a level. But since the changes came in, and they were back in 2007,
But since those changes came in, it's pretty much a dollar for dollar claiming process. But you still see information out there about how old rules work, and if people don't do their research thoroughly enough, they might not necessarily understand the requirements. So you've got to make the declaration that you're lodging by the due date, so the date as we put on that previous slide there, and then sign it. So signing the form, lodging the form, and then the trustee acknowledging it. So definitely, if you're using the ATO form, you'll want to see that secondary acknowledgement. I know a lot of other providers will provide it as a singular form with the information printed up top, and then the acknowledgement down the bottom, and others will obviously provide purely the contribution information on one sheet, and then the acknowledgement as another separate resolution. So that's our notice requirements as such. But then you've got the additional, I guess, key issues linked with the whole capacity to make these personal deductible contributions. This is where, to me, we now enter, I guess, the danger zone, and that's probably overstating it, to be fair. But the area where problems arise and therefore deductions could potentially be knocked back from the point of view of members taking benefits, rolling over benefits, making commencing pensions and other things. So you can't cover the notice can't cover the whole or part of any amount that's covered by an earlier notice, which is the concept that similar to what Nick was saying before, if you have a contribution and let's say you made a $15,000 contribution and you put a notice of intention in for that $15,000 and then you subsequently make another $10,000 contribution, well, you wouldn't then have the statement or a new notice to be for the full 25. You would just have a second notice for that new $10,000, and so ensuring that you're keeping the notices quite separate there. Must be given before the amount is rolled over to another super fund, including splitting. So if we're doing contribution splitting, you've got to have that notice in beforehand, or it's got to be given before the amount is withdrawn. Now, it's not a necessity. Ultimately, it's not a necessity to make a note or to lodge a notice of intention to claim. But if you want to get the deduction, it's going to be a necessity. Otherwise, what you're going to do is limit your entitlement based on the proportion of the tax-free amount that is left immediately after the benefit payment has been made. And I'm going to touch on that in a moment and the way that proportioning works. But I think that's just something to be mindful of, particularly, as I said, strategically, if you've got people that are entering pension phase or entering that post-age 65 easy access stage where they've still got the capacity to contribute to super, then the whole idea of, are we going to draw some out, given that we only ever have one accumulation interest, if we're putting money in and we're taking money out, then that's going to impact our deductibility at the end of the financial year. And so we'll work through that as a process in a moment. It's got to be given before the trustee's begun to pay a super income stream, which includes a contribution in whole or in part. And so one of the big rulings around all this, which was TR 2010/1, what is a contribution? That went a lot further than what the legislation did back in 2007 and the explanatory memorandum. And it really identified this whole concept that once you start a pension in whole or part, then it's got to be assumed that the entirety of that contribution has effectively been used to calculate the tax-free and taxable benefit. So there's none left. So you don't have any capacity to claim a deduction once you've commenced the pension. So the timing of the notice is really critical when it comes to pension commencement. And again, I'll go through an example of that. But given that so many people commence a pension on the 1st of July of a financial year, it really identifies that they don't actually have time to then go and wait until for their personal tax lodgement cycle to determine what their deduction is to be claimed, because the pension commencement on 1 July means we need to know what the components are immediately before that, i.e. 30th of June. So we need to get our tax-free and taxable right. So it's a pretty critical step in the whole pension commencement process to have that notice of intention prior to the pension commencing. And also the member hasn't requested a release of First Home Super Saver scheme. So again, it's about the timing there, because of course, if you're not claiming the personal deductible, you can take out non-concessional under the First Home Super Saver scheme as well. So not a big issue. And also the amount doesn't include all or any part of the following. So these are contribution amounts that we can't include in our notice of intent. And the First Home Super Saver scheme recontribution. So if you receive them out under the FHSSS, and then you don't need it and you put it back into super, then that amount can't be claimed as a deduction. Similarly, downsizer, you can't claim a deduction there. But also from 1 July 2021, we've now got this capacity to recontribute any early release amounts that were released under the COVID compassionate grounds. And albeit that self-managed super funds weren't hugely impacted, but it's not necessarily about where the funds come from. It might be it's where they're being put back into. And so, if we had X 100,000 members taking money out under COVID release and now are contemplating setting up a self-managed super fund, well, they've got this period of time, it's 10 years or whatever it is, where they can put the contribution in and have it excluded from the non-concessional contribution cap by making an election. But they can't claim a personal deduction on that. So, it's one of the things to be mindful of. And, we'll probably need to keep a close eye on these COVID amounts when people are making personal contributions, that from 30 June 22 onwards, when we're actually doing contribution reconciliations, we'll have to ask the question, does any of your contributions for the year, or do any of the amounts that you contributed through the year relate to amounts taken out under a COVID release authority? Because it probably won't be front of mind necessarily for the individual when they're making the contribution. It's not going to be necessarily front of mind from an administrative point of view. So it's really a matter of getting your processes in place now to make sure you don't miss those situations later on, because you don't want to exceed caps and other things as well. So there's some of the key issues. I said I wanted to touch on the proportioning rule. So very quickly, I guess the key point there is that we proportion a member's interest immediately prior to them taking a lump sum to determine our tax-free and taxable percentage. So we need to know what our contribution segment is, and our crystallised segment, which was done all those years ago. The contribution segment is any personal contribution that we make since 1 July 2007 will go into our contribution segment, and it will only flip across to being a taxable amount once we receive that notice of intention to claim. So ultimately, if we put money in, every dollar we put in that's not employer money is a non-concessional contribution. And if we then subsequently take that money out, it will be treated as non-concessional, form part of the tax-free, unless we've got the notice of intention prior to taking that out. So it really is a bit of a trigger event for us that we need to be mindful of. And so when we're looking to claim from a benefit payments point of view, we do have to give consideration to the proportioning requirements, and I've highlighted there for you the ATO's position from that ruling and giving you the reference, paragraph reference 71, and it talks about the validity will be limited to a proportion of the tax-free component that remains after any rollover or withdrawal. So it's critical to know then how the calculations operate to make sure that if you are going to take benefits out, you're not going to get the full entitlement to the deduction. So what I thought I'd do for a few minutes is just run through a couple of, I guess, key examples from the tax office ruling. I have updated them because the ruling does go back to 2010. So I've updated them from the year perspective to make them a little bit more relevant here for us. But the first one is really about the whole concept of a rollover, but equally applicable to a single lump sum benefit. So, where contributions are made and then the money is taken out, or a significant proportion of money is taken out. And this, I guess, is particularly more where you're looking at recontribution strategies and things as people hit 65, and they might be making contributions, but they've got some other income, so they want to offset some of that income with a personal deductible contribution. They're also mindful of the bring forward rules and other things. So they think, well, if I rip out money this year, then I can put it back in, or I can take it out last year. I can put it back in this year as a non-concessional to sort of manipulate or play around with my tax-free and taxable. But in doing that, what impact is it going to have on the deductibility of the contributions they make? So in the example, Rachel, who's 54, so clearly hasn't met a condition of release, but has a super interest valued at 50,000, includes a contribution segment of $10,000, makes a $100,000 personal contribution in March 2021. Fund records this against the contribution segment for a super interest, which means it would be counted against her tax-free component of any superannuation benefit paid to her. So her total value is $150,000. In June, she rolls over $60,000, leaving her with $90,000 in the self-managed fund. The $60,000 rollover is comprised of $44,000 tax-free and $16,000 taxable. And the component is worked out based on our proportioning rules. So what we know from our proportioning rules, if we look at the formula there, the rollover amount, we multiply the rollover amount by our tax-free component interest before the rollover divided by our value of the superannuation interest before the rollover. So that's the same rule, whether it's a rollover or a benefit payment, lump sum withdrawal. We need to know what the entire value of the interest is. The accumulation interest is immediately prior to that. So valuations become pretty important. And then we need to know what the tax-free amount of that is as well. So the 44,000 is effectively the 60,000 of the rollover times 110 divided by 150,000 gives us the 44. We then work out the tax-free of the remaining benefit, or the tax-free component of the remaining superannuation interest, is then 66,000, which is the 110 less the 44. So what that actually would mean is that if Rachel lodges a notice in September 2001, I do like some of these ATO examples because albeit that it was back in 2011, 2012, she was claiming a deduction for $100,000. So, just ignore the fact that she's making an excess contribution here and all the other ramifications of doing that. She tries to make a deduction or lodge a notice for an amount that would actually be deemed as not valid. So because she doesn't hold the entire $100,000, she can't claim a deduction for that full amount. She could only give a valid deduction for an amount up to 60, which is worked out based on the tax-free component of the remaining interest times by the contribution divided by the tax-free component of the interest before the rollover. So our tax-free component is 66,000. The contribution, as we know, is 100. The tax-free component was 110, which gives us $60,000. So the maximum amount that Rachel could claim would be $60,000. Now we know likelihood is that she's not going to, because that would create excess concessional contribution issues. But that's where it basically sits. But I think what's more important to get an appreciation of is the multiple benefit payment and multiple contribution requirements, because I think this is probably an area that a lot of self-managed super fund members would possibly overlook from a conceptual point of view when they're dealing with their fund and their tax returns and these sorts of issues. And so if we look at this example from the ruling, and I've adjusted it for 2021, but a client that started out at the 1st of July 2020 with $224,000 with $74,000 tax-free. They contribute to $2,000 a month. So that's not necessarily unrealistic and again, more realistic than Rachel's example with regards to the capacity to claim personal tax deduction. So they've contributed $10,000. They, for whatever reason, do a withdrawal of $100,000 in December 2020, and then with their additional $2,000, they contribute totally 24,000 for the year, 14,000 after that withdrawal event. They're actually in February they do their notice of intention to claim for the previous year. They've got another contribution that went in between July and Feb. They've taken another $50,000 out in that financial year as well, and then further 16,000. So as you can see, this example, it provides that a lot of transactions are occurring, but the notice of intention to claim the deduction is going to be impacted by the timing of the contributions and then the timing of the withdrawal. So in this situation, the way that the example plays out is Marks has that super value of 224, including 74 tax-free, contributes $2,000 each month. In December, withdraws 100,000. Prior to the withdrawal, the account balance was 234. So we haven't applied or haven't allowed for any earnings and fees and all those sorts of things. It's just straight out maths in the example here, which gives a tax-free component of 84,000, which is the previous 74 plus the new contribution of 10,000 up to that point in time, because no notice has been received. The balance after withdrawal is 134, including a tax-free component of 48,103. So that's a rounded number if we go back and do the same sums from the previous example. The withdrawal is going to affect the amount Mark can include in his notice for the contributions made from the 1st of July up until that withdrawal, because a proportion of these contributions, only a proportion, are going to be included in what's in the fund because he's taken the balance out. And so it's these sorts of transactions that are going to impact what actually occurs. And so the proportion of the 10,000 still held by the fund, again, is applying that same calculation that we used for Rachel as the tax-free component of the remaining interest times by the contribution over the tax-free component of the interest before the withdrawal. So $48,000, which is the tax-free amount left, times by the 10,000 divided by the 84, means that 5,727 of that original $10,000 would be able to be claimed by Mark as part of his notice of intention to claim. Now, of course, subject to the timing of it, we had an additional $14,000 that was made after that withdrawal of $100,000. So if he lodged his notice of intention to claim immediately following the end of the financial year, he'd be able to claim the 14,000 plus the 5,727 from that original 10 to give a roughly $19,500 deduction. But it's just important to recognise that in this instance, Mark then subsequently went and took some more money out in November, and that November withdrawal is going to impact not only the original amount that was taken out, but then also the subsequent contributions made up until 30 June and then made from 30 June up until 1 November, going back to the example. So look, what I will do for everybody, rather than go through all levels of that calculation, is provide the full drawn out example as a part of the notes when we send through the CPD certificate for today's session, just to highlight some of the key issues that we need to be mindful of. So for me, it's one of those areas that, without that thought process, without that checklist from a benefit payment point of view and a pension commencement point of view, would Mark just get to the end of 30 June 2021 and say, okay, well, I made $24,000 worth of contributions, so I'm going to claim $24,000 as a deduction, and the deduction's then going to create some issues for the client. So we need to be aware of how that works. So from a pension commencement point of view, ultimately, again, they've got another example within that ruling, but this really highlights the difference between a pension commencement and a benefit payment, is that the pension commencement, regardless of the value, so in this example, it talks about using 180,000, but then it says irrespective of whether you're using 180 or 140, effectively, once the pension's commenced, it's assumed that all of that tax-free amount has moved over into the pension by the use of the words whole or in part, and there would be no capacity, so no proportioning capacity available if you've got a HARP pension commencement versus a lump sum withdrawal. So once you've started even the smallest of pension accounts, then your capacity to claim a personal tax deduction has disappeared. So it's critical to make sure that the deductions are claimed for prior to the pension amount, pension commencing. So if I was to ask the question, Nick, from a client management point of view, from an admin point of view, when you see clients making contributions, one, do you see multiple contributions being made throughout the year, or singular contributions from a timing point of view?
I think in terms of claiming a deduction, you're usually seeing, I guess, singular contributions in that more lumpier amounts rather than, as you mentioned, drip feeding smaller amounts during the year. But I think where there is that intention to claim the deduction, where the smaller amounts may be drip fed into the fund during the year, is just to really, I guess, focus on making sure that notice of intent to claim is made before a benefit is paid or a pension commenced, given that obviously when it's done as a singular amount or a lumpier amount, is that it's more in the back of the mind as compared to those smaller drip fed amounts.
Yep. So, and then my second question to you from that, from a practical sense, how often would you see clients, and let's say, let's not worry too much about their age, but how often would you see clients taking multiple benefit payments from a self-managed fund during the year?
Look, it does happen. I think with obviously the transfer balance cap, where members have a significant balance in accumulation, is that often they may take multiple lump sums during the year. And so I guess what that happens is that where a deductible contribution is made, that if it's a singular amount, well, then it's more easily in the back of the mind to get the notice of intent to claim done. But where the smaller drip fed amounts, is that it can be something that may not be in front of mind as you're sort of doing the strategy planning with the clients. So look, we do see it from time to time, but I guess it's mostly more clients sort of with that in excess of the transfer balance cap, as opposed to clients with a smaller accumulation interest.
Yeah, well, and that's a really valid point. And as you started talking through that to me, it just sort of dawned that from a strategic point of view, we do often highlight that key issue with people about where do you want to take the money from if you're over the transfer balance cap. Like, do you want to take the money from your pension interest in excess of the minimum, or do you want to draw it down from the accumulation amount? And and I'm not suggesting that our go-to strategy, because it's always done on a client by client basis, but the conversation piece is often, well, if you draw it down from the accumulation interest, well, that helps you from an exempt current pension income point of view and other things. But on the flip side of that is that concessional contributions aren't restricted by your total super balance versus non-concessional contributions. And so if somebody's actually making concessional contributions into that accumulation interest, and then each excess pension payment is treated as a lump sum because they make an election to treat them as a lump sum, then that's going to be a little bit of an administrative debacle if there are more regular amounts coming in and out. So that's actually a really great point. So nice one. So I think it's a timing thing to be mindful of. What I want to finish off with is this whole concept of the excess concessional contributions, and it's really just to, I guess, highlight one of the key things to be mindful of, and to effectively keep on top of mind with our clients now who are potentially looking at their contributions and all the issues that I raised at the beginning of the presentation around the timing of contributions and employers making them in and therefore potentially breaching the cap, is that we did have a significant rule change that occurred for excess concessional contributions from the 1st of July 2021. And so if I give you a bit of a look into the history of excess contributions, so between 2013 and 2021, basically what would happen was if you made an excess concessional contribution, then you would have an excess concessional contribution charge apply from the start of the financial year. And it would be applicable right up until the period of time that your notice of assessment, your original notice of assessment, well, firstly from a lodgement point of view to notice of assessment being issued, up until that point in time, you would have the excess contribution charge applicable. But then what would happen is you would have the shortfall interest charge that would apply from the day your original tax return or the original notice of assessment was due up until the ATO issued you with the amended assessment based on the excess contribution. The shortfall interest charge would take over from the excess concessional contribution charge. And then beyond that point in time, so in this example, you've got the 21st of June 2022 as the payment date for your amended assessment. If the client didn't pay at that point in time, then general interest charge would apply to that assessment. Now, that was our pre-1 July 2022 arrangement. Post 1 July 2021, post 1 July 2021, the excess concessional contribution charge has been abolished. So we don't have that additional levy that applies from the start of the financial year to the end of the year. And whilst I haven't updated the years in the example, what it means and what we still have to be conscious of is that the shortfall charge can still apply from the original lodgement date, so original notice of assessment up until the payment of our amended assessment. We can still be eligible for a shortfall charge. And therefore, if you don't pay on time, also the general interest charge, because the shortfall interest charge is a shortfall on your income tax. And so given that the whole thing is actually about having an amended income tax assessment, that charge is still applicable. But unlike the excess concessional contribution charge, the shortfall interest charge is something that can be remitted by the commissioner. So, it's not guaranteed that clients will have the shortfall interest charge, but it's something that they need to be mindful may actually be attributed to those excess contributions. So it's not just the straight out free for all that I have heard a little bit through the industry where saying, okay, well, don't worry about excess concessional contributions now because there's no excess charge. And so there's no sort of tax issue to be mindful of. Well, depending on the charge and depending on the time frame up until from your original notice of assessment to the amended notice of assessment, there is the potential for the shortfall interest charge to be applied, albeit that they are at sort of record low rates of roughly around 3% at the moment. So we're not talking significant liabilities, but still, to me, it should be enough of a deterrent. And so from a ramification point of view, when it comes to excess concessional contribution, the ATO, when they provide the determination, the excess determination, they will provide you with the opportunity to make an election, and that election will either be to withdraw the excess concessional contributions, which of course means that the money comes out of super. There's effectively it's an 85% because they effectively allow for 15% to go towards the tax liability, and then nothing further to see there. If you choose not to withdraw it, then that money will be counted towards, although those contributions will count towards your non-concessional contribution cap. And of course, the flow-on effect of that is that if you've got more than $1.7 million, then your non-concessional contribution cap is zero. And so the flow on there is that excess contribution will then be an excess non-concessional contribution, and you've got your excess non-concessional contribution, associated earnings, and all those sorts of things to contemplate. The tax office obviously highlight that the maximum tax rate that apply will be 94%, and of course in the worst case scenario that may occur if you've used bring forwards and had large excessive concessional amounts as well. But it's just something to be mindful of with how they operate. And of course, the final part of that is to be mindful of Division 293. And so for those earning in excess of $250,000, what that actually might mean from a contribution point of view. The excess contributions themselves are not subject to Div 293 because they go back in under the marginal tax regime and get taxed at marginal tax rate. So they're obviously going to get taxed at the highest rate, but they count towards the adjusted taxable income calculation for that Div 293 purposes. So I guess to wrap this up for you, I see that there are great opportunities, or we see from a contribution point of view that there are great opportunities to contribute, particularly up to 67, and there will be the capacity to make those personal deductible contributions. So you might have investment income that you're generating that you can offset by making the personal deductible contribution, but it is going to be potentially problematic from the point of view that problematic if you're also taking benefit payments. So like Nick suggested, there's the issue associated with if you're pulling down from accumulation, what is the impact that going to be on making those personal deductible contributions? But you do need to consider the notice issues, particularly around the timing thing. So making sure you get your timing aligned with your various other strategies. And I guess finally that excess contributions are not as problematic as they previously were. But I don't think it's wise to use that as a reason to be too strategically adventurous. And I think, going back 8 years in 13-14, when these excess contribution charges came in, there was a lot of talk about deliberately exceeding the concessional cap because it was about tax deferral, not tax avoidance, because you were deferring the tax rather than doing it under the PAYG system. You were deferring it and lodging it under the amended assessment system. And yes, it's fair to suggest that without the excess concessional charge, that there's less of a tax consideration there. However, when you start to risk things up against the non-concessional requirements, and that, is it worth really taking on these sorts of strategies? And I think that's something to be mindful of. So that brings us to the end of the session. Nick, did you have anything else you wanted to add? And also we see if any other questions come through.
I guess, yeah, as you sort of mentioned, timing and just sort of factoring in, I guess, benefit payments and commencement of pensions, just to keep, I guess, the timing of the notice of intent to claim in mind if you are doing those strategies. And if you have any questions, don't hesitate to reach out. Happy to always talk through I guess a scenario and what the implications may be and what may need to be done. Excellent.
All right. Well, look, appreciate your input, Nick. Always nice to have someone on board to share their thoughts. Thanks everybody for attending. Our next webinar at the end of October, I did promise this last time around, was the non-arm's length expenditure one. I wanted to defer that a little bit just because of this whole contribution issue and the timing of it. So I thought it would be good to bring this one in now, and I'll talk about non-arm's length expenses at the end of October. So we look forward to you all joining us then. Thanks very much, Nick.
Thanks, Tim. Have a good day. Thanks, everyone.
You too.